Let's get across the market open now. Kyle Rodder joining us from capital.com. Kyle, happy Thursday to you. Now, we're seeing further developments, of course, on this this trade war. There's a global trade war now with the retaliatory measures put in place by Canada, the EU. That's certainly further undermining markets.
Yeah, I mean, really volatility in the sell-off that we've seen recently is a function of trade war uncertainty and the impacts obviously on economic growth, but simply the fact that there seems to be sort of a largely, incoherent and improvised policy platform from the Trump administration when it comes to trade that's keeping investors on their toes, and it's keeping, by the sounds of things, or at least based on the data, businesses and consumers on their toes as well. But we're of course now seeing the kind of tit for tat dynamic that typically emerges when trade wars begin, which saw the application of tariffs by the Canadians, the United and Europe as well on US imports. I think the strategy here from both of those players in particular is, obviously to match but not exceed, really on the basis that, they don't want to make the situation any worse or contribute to, a greater escalation. But, nevertheless, they have to respond in kind, and they have done so. The Trump administration has already suggested that, there will be a retaliation to the retaliation, again, as that kind of vicious cycle sets in. And that's, again, causing these fears that things could get much worse from here. The markets largely shrugged that off last night because we didn't see anything sort of material emerge as far as an announcement goes on fresh tariffs from the Trump administration. However, one suspects that it's only a matter of time before that happens. And of course, the big thing overhanging the markets at the moment is that Department of Commerce trade review that's due out at the start of April and will announce probably a big suite of other trade restrictions. So this uncertainty prevails. We did see a bounce last night on Wall Street. But one suspects that we haven't seen the end of the volatility just yet.
Well, and of course there is concern that these tariffs are going to feed into inflation. Yet we have had the latest read on US inflation coming before the raft of tariffs that we've seen, actually coming in lower than expected, which did boost expectations of further rate cuts.
Yeah, we saw a bit of a relief rally on Wall Street, really on the basis that the worst fear is that we do see that tariffs create either a meaningful one-off price shock, which means that the Fed is not able to lower interest rates in the timeline it would have otherwise, or unlikely but still a possibility that the application of tariffs leads to a lift in inflation expectations, and you start to see that kind of vicious cycle emerging when it comes to price growth, which again is unlikely at this stage, but certainly a possibility if you look at recent consumer surveys and the jump in inflation expectations that we've seen there. Nevertheless, that kind of unexpected fall in CPI, core CPI in particular, showed that inflation is down to levels that we haven't seen in almost 4 years. The last time we had an inflation figure with a 3.1 in front of it, in fact, the last time we had inflation this low was 3% back in May 2021. It shows that there is at least a little bit of wiggle room there for the Fed, that if we do see, the likely slowdown that we get in economic activity because of the application of these tariffs and, again, the uncertainty generated by them, that, we have the ability to, or the Fed has the ability to lower rates to at least sort of support the economy a little bit, kind of buffet the economy, provide a buffer for the economy as it kind of hits this possible slowdown. So the markets are fully pricing in now a June cut. There's 3 cuts baked into the curve more or less before the end of the year. It's a fairly significant move that we've seen over the last 6 weeks as, again, this trade policy uncertainty prevails. And it was more or less the reason why we saw that big bounce, or sizable bounce I should say, in the NASDAQ last night, and of course the S&P 500 finishing higher as well.
So Kyle, how's that all set us up for the Asian session?
Well, we're looking at a reasonably positive open, but I mean, the move implied by SPY futures is actually fairly modest. And, if you do look at valuations at the moment, we were dealing with a market that was, very richly valued, especially some of those, corners of the market, which are, heavily weighted as far as composition goes, the banks in particular. And just if you look at the 10-year average for trailing price to earnings, as a crude guide to where market valuations are, we're not back to sort of that average just yet. We're a few percent away possibly, which kind of suggests that maybe there's still some air to come out of valuations before we really hit a bottom, notwithstanding as well that we'll continue to see a sell-off if trade uncertainty persists. But nevertheless, we've got futures pointing to a little bit of a lift at the open. Asian markets have actually been fairly resilient over the last couple of weeks, especially those tech stocks in China and specifically in Hong Kong, we're expected to see a little bit of a bounce there coming through this morning as well. But I mean, there's still just this general trepidation that things can change, either through a errant, comment from Trump, like there was last night or the night before, I should say, with those kind of 50% tariff threats on Canada, or maybe a Truth Social post that really throws the cat amongst the pigeons. But at least this morning, that sort of positive Wall Street lead looks like it'll lead to a little bit of a bounce in the ASX 200 and sort of pull it away very marginally from that kind of technical correction, if you're buying into that sort of stuff, that we tested yesterday.
Kyle, you mentioned China there. Interesting, we haven't really seen that the trade tensions develop between the US and China. Should we expect that? Is that a focus, do you think, for Donald Trump, given what he said in the past?
I think so eventually. I think he's been distracted by, trying to strike a, peace deal and win himself the Nobel Prize and, with the conflict in Ukraine and Russia. And, clearly as well, distracted by the fact that, Europe seems to be taking a, fairly hawkish stance when it comes to sort of trade and foreign policy relative to, recent history or, by the EU standards. And of course, there's a matter of what's going on in Canada, the very tough line the Canadians are taking on this kind of trade situation, especially now that, Mark Carney has taken the Liberal leadership and sort of wants to, brandish his tough guy stance on the United States, especially considering that, obviously the Canadian public has been sort of galvanized by some of the rhetoric coming out of the White House. But I mean, the Chinese have been fairly measured and fairly calculated in trying to make sure that they remain, a good global citizen, at least in terms of rhetoric, and sort of being a representation in lieu of the United States of the sort of global rules-based order and the existing trade system, and have sort of applied tariffs fairly selectively, and they tend to, apply them on things that are, targeting some of Trump's key constituencies, so a lot of the agricultural sectors and things of that nature, but have done so with, the perhaps old Nixonian approach to foreign policy, which is to speak quietly but with a large stick. One expects that this would end eventually, that there will be some focus returned to the Chinese, especially once the Department of Commerce's full review on trade relationships are released, because China does have some things to answer for when it comes to unfair trade practices. So I suspect this will be a temporary reprieve, one mostly driven by the fact that Trump is distracted. But nevertheless, for now, if you do look at market action in the region, fairly positive. We've avoided some of the worst of the trade war so far, and there is also that dynamic that given the sort of developments we've seen in Chinese tech, Hong Kong tech specifically over the last few weeks, some money's just simply coming out of Wall Street and going into some of those names which were fairly depressed. So again, only a very temporary dynamic, I think, but for now, a degree of resilience, both because we've avoided the worst of the hawkishness, the trade policy, but also because the markets are looking at a slightly better outlook for some of these companies in Asia.